Okay, so you guys are in for a riveting day today on investment properties, which is a hard topic for me to teach, and I'm also doing it while using this new video system that Dave hooked me up with, so we're trying to work in all the new technology, which will be great once we get it figured out, and we have been practicing, but it takes time. So this video system is going to help with the audio from the audience, and it's also going to allow us to record things a little bit better so that when we send out the notes afterwards, that we have good video footage of it. So I'm excited about it, but we are probably going to run into a few snafus. So we do have a lot to get started, and I don't know if I'll get through all of it today. But I wanted to tell you a little bit about, well, one reason I don't really like to go through this information is because it's so complicated and there's so many different directions that you can go in. It's really hard to fit it into a 1-hour course. So I tried to simplify things as much as possible and give you the most pertinent information so that when you leave the class, you're armed with information that you can use that's tangible. But I also, some of you have heard this story before, but when I was, I think it was in 2nd or 3rd grade, at conferences they told my mom, okay, Rachel's really not good at math. So this was a time when we didn't have computers, and for those of you who don't know that era, we started out with like the Atari and some of those crazy old systems, and one of the systems that they used when I was in 2nd or 3rd grade was it was basically a computer system, not a computer, but a program that hooked up to your TV, and you had to take it home in this big backpack with like a joystick and keyboard, and it was something I had to carry separate because it wouldn't fit in my backpack, and so all
it wasn't like this?
It wasn't really thin like an iPad. All the dumb math kids, quote unquote, at that time would have to take this home and do additional practice hook this thing up to your computer and do additional practice online. And so I think that forever scarred me for life. Maybe explain some of my weird quirks now. But nonetheless, then I went to high school, and somehow I managed to get through. But I noticed that all the cool kids at the time were what I thought were the fun people, were in the pre-algebra, and even though I probably could have done fine in the older math, or the more, not older, but the more advanced math classes, I was determined that I was going to be in the class where all the fun people were, so I specifically failed out of the algebras to be in pre-algebra so I could be around all the kids that like to have fun. I went to college, went to Calvin, and one of the things that you have to do is you have to test in to a math course at Calvin, and if you don't test high enough, then you have to take math. And lo and behold, I actually passed, even though I never went to those advanced levels, I actually passed Calvin's math test, which is not easy, and so I didn't have to take math at Calvin. So I guess you can conclude from that story that I am capable of doing math if I put my mind to it, but it is not my favorite thing to do. So we're going to be talking a lot about equations today, and so like I said, it's not my favorite subject to teach, but I think it's important for all real estate agents to know how to actually analyze investment properties for a client. So that being said, oh, Dave, now I can't change the slide.
Just press the arrows on
Got
the
it.
keyboard. Yeah.
You guys see that? I mean, you guys can't see that because you're seeing this thing on the bottom, but. So it says, you mean to tell me that investing and speculating aren't actually the same thing? And so we as real estate professionals aren't taught a lot in our pre-licensing class about analyzing investment properties. So oftentimes I think we go into it speculating versus actually really understanding and analyzing what an investment property means and what the best value is for your client. So I just thought that was a little funny thing to start us off on some pretty serious stuff. So I'm going to first start and talk about a few concepts that I think you'll want to know while we talk about this process. And the first one I'm going to talk about is your cap rate. So that is the ratio between your net operating income produced by any asset and its capital cost. So either the original purchase price or the current market value. So when we're going into a property, when we're looking at the cap rates, we're first starting to figure out, why is this moving? That's not, I'm just seeing things. It's the camera, the camera that's on. We're starting to talk about either what the original price was if you're analyzing it for a potential seller, but if you're analyzing it for a buyer, you like to look at the current market value for a property. So this number right here, the cap rate, does not include or factor in your mortgage payment, okay? So you need to make sure that you understand that, because if you have a buyer that wants to purchase and they're going to get a mortgage for that property, a cap rate is important to understand, but it also doesn't factor in all of their costs associated with purchasing it. Does that make sense?
Yes.
And you guys can jump in at any time and ask questions, because I don't want to just sit up here and talk. I want some dialogue in the class. But it's important because it is a good apples to apples comparison to other properties that have other financing structures, okay? So that means when you're looking at multifamily properties, maybe a 4 or 5-plex, the bank might only lend if you put 25% down, right? But if you're looking at maybe a single family investment, you might be able to put less down. So it's a good comparison when you're looking at, hey, I'm working with this buyer, and maybe this buyer is looking at single families, but they're also looking at multifamilies. What is their cap rate going to be on one versus the other to determine what would be a better investment for that person, for that individual, whether it be single family, multifamily, commercial, whatever it is. And it's often used in commercial properties to help determine market value, but it is an income metric. So you need to understand that it's also an income metric. Second concept I want to talk about is cash on cash return. And cash on cash return is how you determine the return on the investment, also known as ROI. So if you have multiple properties with different down payment options, again, you can use this to determine, along with a cap rate, what is the best investment for that client. It's also an income metric, and it's used to compare other properties hand in hand. So it's equal to the before tax cash flow divided by the sum of all of the out-of-pocket costs to acquire it. So again, equal to the before tax cash flow divided by the sum of all the out-of-pocket costs to acquire it. Any questions on that? This is a lot, guys, I know. The third concept that we want to know about is your total return and internal rate of return, which is your IRI. And I'm not going to go into detail today about the calculations of IRR because it's quite complicated, but there are, if you Google it, there's several calculators online that can help you determine that. But this concept accounts for equity appreciation combined with your income. So you're looking at properties over time. What is the property going to be valued over time if they own it for 5 years or 10 years? And it also takes I just said that, takes into account the role of money over time, and it's a long-term way to evaluate your investment's ROI performance when you sell it. This is also called, when you're talking with people who work with a lot of investment properties, your capital or net present value or your yield. And it's also helpful when you have uneven cash flows or depreciation. So, specific properties that this would be helpful for example, would be, hey, if your client is looking to purchase storage units, like a location where they're going to put storage units where there's a large amount of uneven cash flow over time. This is a great way for you to value that. So when we're working with buyers, and then we're talking specifically multifamily properties in this case, it's really important to pay attention to the operational value when you're working with a buyer. So when you're working with a buyer, the seller's asking price is irrelevant to you, right?
Isn't it always?
It always is, yes. It's always irrelevant to you when you're working with a buyer. You and the buyer are the people who need to determine the price of that property value, right? Which then becomes your offer. And with multi-units and investment properties, if it's a package deal or an individual deal, the value is based on the cash flow of the property, right? But to save you time, it's important for you to do some investigations before you do a physical walkthrough when you're looking at investment properties for a potential client. And I'm going to talk a little bit about why that's important. So we know that when we put money into a mutual fund without looking at its past performance, it doesn't make sense, right? You wouldn't put your money into an annuity if you didn't know what the annual interest rate is. But when you make a real estate investment, you must have a reasonable estimate of what your return will be at the end of the day, right? And your return, also known as cash on cash, is your net cash flow as a percentage of your down payment. So if you do a preliminary screening for the client, you're basically giving them an educated guess on how the property will perform in terms of cash flow based on a brief top line evaluation, right? And then you're not walking through a whole bunch of investment properties, because investors don't want to waste their time, right? And they're looking for you to be the expert to say beforehand, before they go and walk through a million different properties, what is this investment going to do for my return? They're not going to live there. There isn't an emotional attachment to it. Any questions on that? So here's a basic way to, yes? Mary?
Hey, so these are things that I guess I always wonder what my role is in like looking at numbers for my investor clients versus them doing their own calculations, since they know investors can all have different ways of determining if it makes sense for them. And I think also just because I'm nervous and I'm not used to running those numbers, that I would hate to give some of the wrong numbers. So I'm curious, like, so you run through these numbers and help do that for your investor clients?
Absolutely. And I think that's why you need to get really good at it, and this will just give you you, like I said, a top line evaluation. And sorry, Mary, did you say something else?
Oh, no, that's it.
Okay.
Yeah, thank you.
You're welcome. And there's going to be some savvy investors that are going to, know this stuff offhand, right? And you'll work alongside them. Doesn't mean that you don't need to cross check their work and pay attention to it as well, but you're an advisor, right?
Well, also when you're sifting through listings, if you know the information and it's not a good investment, don't present it to your person.
Yeah.
No, you're not wasting their time. You don't look like a dummy.
Yep, Kyle said if you're sifting through that information and you don't think it's going to be a good investment, don't waste their time and send it to them, right? But here's just this is a dummied down, basic 5-step evaluation, and I'm going to talk to you a little bit about, okay, why do we do this? Where are we going to uncover some of the inaccuracies, and then be able to analyze that for a potential client. So the 5 steps are to verify the property income, verify the property expenses, determine the NOI, find the cap rate and valuation, and then calculate the loan payment and your profit or cash on cash.
That's the other thing, sometimes the listing broker won't have the right information, so you gotta be able to do this to verify it. Otherwise, you send them the listing, you think it's a great deal, and then out of nowhere, the investor comes back and says, this is terrible, what are you sending me this for? And it's cause the numbers were all wrong on the seller side, and you just relied on them. So.
This is a great point, and Kyle just totally forecasted
I've
what we're
learned
gonna
from experience.
talk about, yeah. Can you guys online hear the people in the audience?
Yes.
Okay, great.
I can kind of, but it helps Rita when you recap it. I appreciate that.
Okay.
I agree with Mary.
Okay, so Kyle said it's also helpful because oftentimes the seller's information is incorrect, which he just totally led me into the next section of this course. And when you send something to a savvy investor and the information is all incorrect that the seller has provided to you, then you look like an idiot if you haven't actually pointed those inaccuracies out. So we're gonna talk through that today.
Quick question.
Yes.
Just thinking, would it be smart, even before, walking the property, determine what your comps are and determining what they're getting for rent? So when you do walk through it, you can see where, if you could improve the property, you could also increase your rent, which then would make it better for you.
Absolutely, absolutely, and that's definitely something else that we're gonna go through today. Like, how are you talking about, okay, past income, how are you looking at future income? Where are you uncovering some of those inaccuracies? That's a great point, Brandon, thank you.
You'll also have to run your potential new sale price, cause it'll affect the property taxes.
Yes, property taxes, sale price, new sale price, all that is great. So, the reason we verify the property income is because with the primary residence, generally, the bank secures the mortgage with your own assets, right? With investment property, the loan is most often secured by the income generating potential of the property itself, but also combined with the credentials of the buyer, particular buyer. But they do a lot look at what is the income generating potential of that property itself when loaning money for investment properties. So there are 3 types of incomes that you need to consider, and those are the actual income, so that's the total income of the property generated in the prior 12 months. The actual potential income, the total income the property could have generated in 12 months if all the units had been 100% occupied. And the future potential income, which is the total income the property could generate with today's market rents. So 100% occupancy and taking full advantage of all the other income opportunities, coin laundry, etc. of that property. So the key here is that sellers will always try to sell and put their asking price based on future potential income. But buyers should be buying based on actual income, and most estimates given by the sellers are inflated. So how do we figure out what the actual income is? We request the rent rolls to verify the figures are correct and not based on estimated rents, right?
And their expenses.
And expenses. So there's a few key elements for calculating the income on a property. One is vacancy rate, and we calculate vacancy rate by the number of vacant units times 100 divided by the total number of units. Does that make sense? So it's highly unlikely that the property is going to be 100% rented all the time, right? So if you know the vacancy rate on the pro forma that they give you is below or average for the market, then you need to verify with the property manager if you know the company managing it, and find the information at the monthly rent rolls or move-in dates on the leases. So request it from the property management, see whether or not the vacancy rate is in line with what the property manager says, or take a look at all the rent, or the leases, and look at when the lease dates are and when they were vacant, to verify that. Currently, vacancy rates are actually, buying investment properties, they're right in line with that 6 and 7% for the last 10 years, and that's for residential property. I don't know, commercial property offhand, it's probably pretty, I think it might have been more like 8 or 9%.
Industrial right now, I know there's like 2% vacancy throughout Grand Rapids.
Right.
They cannot find industrial property.
Yeah, and that's gonna vary, that's a good point, Kyle said, that's gonna vary depending on what type of investment property that is. So like industrial, yeah, industrial is gonna be really hard to find right now. So their vacancy rate is really low because everybody wants industrial property. But if you're looking at like retail property, it might be more like 10 or 12. So you kind of average it out depending on the type of property that you're looking at.
Rachel?
Yes.
Is this for bigger properties, not like duplexes that are 2 to 4 units?
No. That's a great question, Chris. That is definitely for, I think, single-family investment properties. It's as relevant as multi-family investment properties.
I find like some of my property owners, they don't even keep, like the last one I just sold, she doesn't even have a lease contract with them. So I never was asked that when we sold the property, about, but tenants were terrible at paying, so I was never asked any of those questions, so I just was curious.
Yeah.
There's single people out there, they have 1 or 2 properties and they just don't even.
Right, and Chris, and if you're representing the seller and somebody doesn't ask on the buy side, then that's their own their own fault. But if you're representing the buyer and there's they're buying a single family investment and the tenants have been terrible, you're gonna wanna know that information for your client when calculating the value.
Well, and secure a lease.
And secure a lease, yeah, a long-term
We're gonna be
lease.
rented.
Yep.
Question.
Yes, Jody?
If you were doing a single family, it's a single family home, but like say for college rentals, it really would become like a multi-unit is how you would look at it, correct?
Yes, I think if your primary audience would be college students, then yeah, you're looking a little bit on what they're charging per room for a residential property. Yep, great point. So the income section on the pro forma is where the seller lists the property's income and their vacancy rate. And the income from the rent minus the average vacancy for the property plus the other income is how you figure out the difference between the two. So I'm gonna show you just an example, and these are all random numbers, so don't pay attention to that, or it doesn't really matter. This is obviously a larger property, whether it's residential or commercial, but their gross scheduled rent on the seller's pro forma is $48,000 a year. And we're looking at less the vacancy rate, which in this case was 7%. So you're minusing out that $3,360, which brings you to your net rental income of $44,640. And they also had some additional income at $480. So your total income for this particular property is $45,120 based on what the seller's pro forma said. Okay? Yes.
I think someone who's in on their phone isn't muted to keep like clicking in and out.
Anybody on their phone? Mary said she's getting a lot of feedback.
It looks like someone keeps trying to say something.
I'm on my phone.
Hey Wendy,
Here.
so if you guys are on your phone, if you mute it until you wanna talk, it won't give feedback.
If I only knew how to do that.
If you click on the screen, it should pop
iPhone.
up a little bar at the bottom, and there's a mute button. You click it, it'll turn red.
Got it, thanks.
Cool.
Thanks,
Yeah,
Mary.
you're welcome.
So, now we're on verifying expenses. So in this particular case, we've got repairs and maintenance, and we've got the per unit amount, we've got, the total on the, seller pro forma, and then the last year's actuals. So now we're analyzing, based on what the seller said and what our, estimates are. We're going through utilities, real estate taxes, insurance, replacement reserves, and we've got, our total expenses on the bottom, right, per unit and also total. Now, if I looked at this pro forma, I would say, I would look at a few different things. I would say, okay, are the properties separately metered? Right, we need to know that. We need to know which, utilities the buyers, or the tenant's paying for, and which the landlord's paying for, and how they're dividing that out. There's also several other expenses that, we could be missing. Is there HOA fees? Is there anything else on there that we think the property has as far as expenses every year that is missing from the pro forma, right? Hi, Shirley. So here's where we're starting to expose some inaccuracies, okay? So I'm looking at this pro forma, I'm looking at the actuals, the per unit, and the prior year actuals, and I'm saying, okay, what do I need to find out for my client? My first red flag is going to be our repairs and maintenance, okay? So why is that, guys?
It's a fluctuating number, changes every year.
It's a fluctuating number, that's great.
It indicates how much deferred maintenance is on the building. Or
Right.
was.
Right, and Kyle said it indicates how much deferred maintenance there was on the property. Because the prior year actual was 8,010. But the seller's estimate is lower than that. Right? So why is that? We need to ask those questions. Why is it that last year you spent 8,010, but now you're at 6,700? Because that's a $1,200 difference. So we.
Could it also be that the seller just is letting the property go?
It could be that, deferred maintenance, yes, that's a great point. It could be the sellers stopped doing the normal maintenance that they needed to do every year, and or they had an increased expense for some reason in the prior year actuals that we need to know about. But also, have they just let things go, and is that a room for negotiation for you? Our second red flag. Hi, Rochelle. Okay, why is my yellow thing not coming up? There we go. Is utilities, right? What do you see there?
There's $100 difference.
There's $100 difference, right? So is that in line with your standard rate of increase in utilities every year?
Fine.
Right? Or is it because there's another tenant in there that's using more utilities? But nonetheless, you want to dive really deep into these figures to say and ask the deep questions on, okay, this was $100 less. I know that DTE or I know that gas and electric go up this percentage every year. Is that in line with that? Or is there another reason why those utility costs are lower on the seller's pro forma than the actuals?
Ideally, you wanna push that off onto the tenant anyway.
Ideally, you want a property that, yes, that the tenant pays those utilities. Red flag number 3.
Hey, Rachel?
Yes?
Is an average that the utilities and gas go up a year?
I think it's 1 or 2% around the standard inflation number. So within 1 or 2%. It really is volatile in some respects because it depends on the economy.
Very,
Yeah, it depends on trade, it depends on all sorts of stuff, but I think you can get a standard figure, but my advice would be to call the utility companies and say, what was the rate of increase from last year to this year? And what do you anticipate for next year? Our red flag number 3 is our utilities, or our taxes, which I think Kyle mentioned earlier. What do you see here?
They're consistent. But that'll change as soon as you put a new sale
They
price on.
never stay the same.
They never stay the same.
Oh.
Your taxes
So
always
they're
go up.
estimating, or guesstimating.
So yeah, they're taking the same number from the prior year to this year, which means there's an inaccuracy there, right? So what do you do then? You use both the prior year and your projected taxable value for the future to determine it more accurately. So what are they going to be paying on that property for the next year once they reassess in May?
Does it really make a difference what the past seller was paying in taxes? Like if you calculate it based on the new, I mean, if they've owned the property for say 20 years, aren't the taxes gonna be so different from what your seller's gonna pay anyways, that it doesn't really matter?
Absolutely. So Drew said, why even look at the past year's numbers? Because if they've owned it for 20 years and the taxes have not gone up, and then they're buying it based on a whole new purchase price, it's 20 years later, I would say err on, you know, depending on when the seller purchased that property, you wanna pay good attention to that, right? Because maybe if they've owned it for 20 years, you only wanna base it on what their new taxable value might be estimated at. Any questions on that? Number 4, insurance. Does insurance stay the same year from one year to the next? No. So if they provided me with this, I would ask the question, what actual insurance numbers should I be projecting? And how do you do that? You call your local rep to figure out the cost of that insurance. Because it will inevitably change based on sales price, based on inflation, based on all sorts of other things.
Crime report from the local area, do they look into that when they insure your home?
I would suspect, yeah, Kyle asked if they look at the crime report. I would suspect in some instances there are insurance companies that do that, but they also look at, okay, what claims have been made. And insurance now is like Carfax or whatever, where they run an analysis and say, okay, if this person had a big huge flood, now your insurance, it doesn't matter if it's a new owner, it's gonna go up the next year. And so that's why I always recommend in the first 10 days to contact the insurance company to do that background check on the property. Then your number 5, your replacement reserves. So replacement reserves are the funds that you set aside for inevitable replacement of capital items such as carpet, roof, whatever needs to be done on that property to get it re-rented, okay? So it looks like the seller did not spend a dime on replacement reserves the prior year. And so they're projecting that this new buyer will have to pay $1,200. Well, why is that? And why didn't they spend any money last year? And is that room for you to negotiate that price lower because, hey, you didn't do anything to that property last year. Now you want me to pay your deferred maintenance of $1,200 for replacement costs. I'm going to negotiate that when I'm talking to you about an offer. Anybody have any questions on that? And your replacement reserves could change after you walked through that property, right? you may walk through the property and find out that there's a lot more that needs to be done to get this up to speed for tenants, and so I might have to increase that a little bit. So now we're at step 3. We've analyzed the income, we've analyzed and verified the expenses, we found some inaccuracies, we changed our numbers. Now we're going to determine what we believe the net operating income will be. So again, this does not include your loan payment. So seller says on our pro forma before, okay, their total income for the property is $45,120. And expenses is $15,573. And so if we assume that the seller's numbers are correct, as they disclosed, and we do the calculation for that net operating income, so we do the income minus the expenses, leading us to a total net operating income of $29,547 for the year. Okay? So remember that number. We go to step 4, which is to find the cap rate. So we take the net operating income divided by the new purchase price, or the trends for comparable sales in the area. And our actual property worth, or offer price, is our net operating income divided by our cap rate. Any questions? So, if we look at example 1 with what the seller says, and we say, all right, our net operating income is $29,547. We figured out our cap rate is 8.74. We divide that 29,000 by our cap rate. Our number right there is where our offer should not exceed. Okay? So $339,000. Should not exceed that. Now, what if we went through, when we were doing our analysis, and we decided that actual income projected was actually $39,451. Okay? So that's just $6K less than what the seller pro forma. And our actual expenses was really $17,083 versus $15,573. So what the seller said was $15,000. So it's just $1,500, just over $1,500 more in expenses, and just under $6,000 less in income. Those are small. Those seem like small numbers, right?
Mm-hmm.
But then when you go and do your calculation for your net operating income, with the expenses at $22,368, I have a calculation wrong there somewhere. Oh, income minus with expenses. Never mind. I have it correct. So with your NOI at $22,368, and you divide that by the same cap rate, your number's $200,055,926. So your offer shouldn't exceed that amount. That's $83,000 difference in the property value. So as you can see from this example, if you just have a few changes in those numbers, those figures, it can change what you actually should be offering on a property. Does that make sense? Any questions? That makes sense?
Question.
Yes.
So if you are going to have somebody else manage it, is that factored in the expenses, or shouldn't you count that against it?
That would be in your expenses. So you take your total income, and then if you were having someone manage it, then you would figure out what the management fee was for a 12-year period, and you'd minus that out. Great question. Okay, so now we're trying to figure out our, factoring in our loan payment, so we know what that cash on cash actual, profit is. So we do this by taking the net operating income and we minus out our loan payment. Our cash on cash return is our profit from that property divided by the down payment or total initial investment. So that includes your closing costs, that includes all the other things that the seller had to put in initially when they purchased, okay? To determine your cash on cash return. Questions on that? So why do we use cash on cash return? So we can look at evaluating two different properties like we talked about earlier. So say we're evaluating two different properties and these are just theoretical properties and we've got a buyer who wants to buy a single family property for $100,000. They're putting down 20% to purchase that property. And with their closing costs and total costs, they're at $25,000 in their initial cash investment. The rent is $1,000 a month, and their total monthly expenses are $800. So we take the total monthly income, 200 times 2,400 a year, and our total income of 2,400 divided by our total initial investment, which equals a 9.6 cash on cash return. Make sense?
Yep.
So here's our total monthly expenses. We're putting in $2,400 a year that we're making. We're dividing that by our total initial investment, and we put in $25K at the beginning, so now we have a 9.6 cash on cash return.
Rachel, will you share these slides with us?
Absolutely. I know this is a lot. Yep, you'll get all these. So property 2 is a 2-unit, and we're buying it for $160,000, but we have to put, because financing requires us to put 25K or 25% down. We're going to put 25% down on this property. Our total initial investment, including our closing costs, is $45,000. Our rent yields are higher than the previous property at $1,600, and our total monthly expenses are also $1,300. So our total monthly income, which is $3,600 net a year, divided by our total initial investment, which is $45,000, equals an 8% cash on cash return. So this buyer may be analyzing these two properties and saying, hey, on a single family property, I don't have to put as much down. My cash on cash return is higher, even though my monthly rent is higher on this property because I have to put a larger initial investment into it. So if you're looking longer term, this buyer might be more interested in single family home with less initial investment than multifamily home with larger rent. So it's not just a rent thing. It's always really digging deep into all those details.
Rachel, if it's a cash deal, if they're not doing a mortgage, you would just simply leave that out of the equation, correct?
Right, you wouldn't put your mortgage in there, you just look at their, total net operating income and their, and what their return is at the end of the day, their ROI. Good question.
What about, especially like a buyer now, what about someone that wants to purchase with cash to give them a competitive edge, but then refinance later? How would you run it as both?
Yes.
Yeah.
So Drew said, what about if it's somebody who wants to purchase cash right now, but then they plan to refinance and get a mortgage? So would you run it at both? Absolutely, I would run it as both, for sure. Because, and that's gonna obviously change depending on when they refinance. But if you do an initial analysis for them and then just explain to them that this could change depending on interest rates or whatever down the road, then I think you're good. And then finally, looks like we're probably gonna get through everything. You guys didn't ask as many questions as I anticipated, so that's good. But some other just key terms, and again, this is much more complicated than what I'm just going over today. I'm giving you a brief overview of how to intelligently speak to somebody about some of the basic concepts, and then I also want to encourage you guys to start when you're working in investment clients, because I've worked with them before multiple different times. You will spin your wheels if you do not do this initial analysis up front before just bringing them around to different houses. And they don't want to be dragged around to different houses because ultimately they're not emotionally connected to that property. They're looking at the dollars and the figures. And if you come to them and say, hey, I've analyzed this before, or they say, hey, look at this property, and you say, I've uncovered X, Y, and Z potential inaccuracies on that pro forma, you're ahead of the game compared to most people when working with investment properties, unless you're somebody who's really well versed in it. So the other key terms I think you guys should walk away with today are your gross rent multiplier, and that is your purchase price divided by your gross scheduled income. And in the gross rent multiplier number, you always want the lower number, so the lower the better. In your net income multiplier, you're looking at your purchase price divided by your NOI, and again, the lower the number, the better there. And then your third concept is your expense ratio and total operating expenses divided by your gross operating income, expressed as a percentage. So a percent below 35 is generally good in those cases. So why do we know these things? Because if you have a savvy investor and they ask those questions, these are concepts you can know. But when you're helping people with initial investments, I think if you go through that 5-step properties evaluation and you uncover those things, and then you can talk through the NOI and you can talk through the cap rates in the area, then you're probably on a good start to figuring out what that property is worth for that potential client. Go ahead, Sherlyn.
Where do you guys find what the other properties are renting for that are nearby?
Sherlyn said, where do you find what the other properties are renting nearby? And here's the deal, when you're looking at especially residential multifamily units, it's the way you price them is much different than when you're looking at a single family home, right? Because when you pull up investment properties, say you're looking at just 2 units to 4 units, right? And you do that initial analysis or that CMA on it, it doesn't show, like, we start with price per square foot and then we add additional things, but it doesn't do that because the square footage is calculated differently in a multifamily home. So there are, and I will send you a link to the app that I have. There are apps that have general ideas of rents specific to different areas on what's average for that area, but also when you look through your comps, like if I priced out 6 multifamily homes this week. When I looked at them, I was looking specifically at the rents based on how many units were in there to see where the average kind of played out. And then you can cross-reference it with a specific app that I'll send in the link to see if that's around the averages in the area. Does that answer your question?
Yes.
Okay, great question. But it is a little bit more complicated to price out. You really want to look at how many units are in there. And oftentimes you're not going to be able to figure out what those numbers are, whether they're separately metered right off the bat. I mean, sometimes they say it in the comments, but it's a really good question because you can change your expenses drastically, right? If you can't control the heat in that property, and you're just dividing it up, one, it changes your numbers because then you're responsible for collecting it from the tenant. But 2, it can change based on what tenant is in there, and if you're not controlling the temperature, that's a problem, right? And so you have to forecast on what you're gonna have to spend in future years if that utility cost is worked into those rent amounts. So ideally, I don't really like to sell people rental property that don't have at least gas and electric separate. Any other questions on those things?
Is there a rule of thumb of what you should be making as far as income over expenses, what you should look for? All that 35%. But in your example, it was $800 a month was your expenses, but your rent is only $1,000 a month. To me, that's not worth it. The $200. I'd rather work to find a lead and sell a home than that. So, what do you look for, Kyle, whoever, to have as far as a percentage of expenses?
So I think in any business you wanna be at 30 to 35% above. So, but it also depends, and Brandon, this is a really good question, it also depends on if you're looking at it short-term or long-term, right? So somebody might be investing in a property so that they can sell it, and they might make way more down the road, and you're looking at your IRR more than you're looking at your yearly expenses. So how long are you going to hold on to that investment could make a difference in that, and how much do you think that investment would change over time, right? Because when we're figuring in our IRR, we're looking at, okay, today I'm buying it for X amount, I'm making monthly amounts of this amount, but I'm also looking at making $5K after a year in equity, right? So it somewhat depends on the long-term plan of that client, why they're purchasing it. And if you're talking about investments to flip, that's a whole different story, because you can't make that amount over time on a flip necessarily, right? Especially not right now.
8% or whatever your cap rate is your annual gain.
Yes.
And
Yep.
not your long term. You can have somebody pay off $100,000 of your equity. You didn't pay the equity, they did. And then you go and sell that property, and you get $100,000 plus whatever you made, 8% or 9% over the years that you had the property. So
Correct.
it is worth it, because you're still gaining an asset, and somebody else is paying for the equity in that asset.
Yes, that was exactly what I was trying to say, but he said it much more eloquently.
I learned from Steve.
You're paying for an asset that, you know, appreciates over time in some cases, but that cap rate is an annual rate, right? And so the lower the cap rate, the less money you make as a seller. But the higher the cap rate, the more risky it is for a buyer.
Like the stock market, there's like what, 8 to 10% per year, growth is what you expect, or
Yeah.
is what's average. So if you're putting 8%, if you're getting 8% from real estate, you can get up to 15%. I mean, all depends on how you can lower your expenses and increase your rents. But that's your annual. You're still building equity, whereas you're not building equity in the stock market.
Correct. So yeah, it used to be that investors never really wanted to go below that 8% number, right? But now they're looking at less rate of return initially, and some of that, it depends on, okay, can I go in and can I make capital improvements of X, Y, and Z to increase the rent? Maybe the cap rate right now is 5 or 6%, but if I upgrade for X amount of dollars over the next year, I can increase my rent to this amount, and my cap rate would change however many percentage.
Well, like Miami, Florida, a four cap is a good property in Miami, but here in Michigan, 8 cap. If you got an 8 cap property, people don't want to look at it. They want 8 or higher. But in Florida, where they think the property values are going to skyrocket over the course of time, you can make an equity play 4 cap all day, because you're still making money. You're not going backwards.
Yes. So, for those of you who couldn't hear, Kyle said it depends on the area too, right? So somebody in Florida might be comfortable with a 4 cap, but here they might be more like 7 or 8%, right?
But even here, how important the area is.
Yeah.
Those growing areas, like down by the college in John Ball's Zoo, what's happened in the last 5 years there, and across the street from the hospitals and stuff, where there's still some opportunity, but it's gone up exponentially higher than other areas in the city too.
Mm-hmm. Yep. Yeah, there's certain areas that are more less risk adverse if you are looking at those lower cap rates, right? If you're looking at like multi-unit properties, also the other thing that you need to do when you're talking about package deals is, okay, so cause we're seeing a lot of those over by GVSU, right? They're selling multiple properties. Are you paying attention to the, per unit value on it? So the seller puts it up for $1 million and there's 8 units and they're $800,000 and they're $100,000 each. Is that in line with what makes sense for your investment? Does that make sense?
Those package deals, sometimes they put a stinker property in there too. Hey, we can't sell this one on its own, so we'll put it in a package deal.
Yes. A lot of times investors will sell things as package because they want to wrap in some bunk properties. Any other questions?